in the morning. I've been up since about 4:30, and the reason why I got up early is because I was a bit worried. So, my parents are retired, and they're trying to figure out how to manage their money. They're close to turning to an institution for direction, and I just do not trust institutions at this point in time. Uh, and this is why. Um, Whoever works for a bank will be given instructions on how they should manage their clients' money and what are the limitations to manage their clients' money. Um, they have a job to do, and they have to follow the rules of their job, right? So I do not believe that someone who you go to at a bank will manage their money as they personally see fit and what they personally see as what's in your best interest. They are trying to keep their job and follow the rules so that they do not get fired. They're not going to do something outside of the boundaries they are given for your benefit. And because of that, I drew up a very simple portfolio for my parents. I personally would be a little more aggressive, but that's not the point. My point of the portfolio for them is to, one, make it very simple, diversified enough so that if one sector takes a hit, it doesn't bring down their portfolio significantly. And three, for it to be easy for them to understand and not lose money and value as the fiat system is crumbling. Now, my plan for them is for them to enter 20% of the cash that they have allotted. So every quarter to enter into this portfolio that money so that one, they could see the performance compared to the loss in their money, and they could take advantage of any opportunities that may present themselves as everything is shifting. Because see, the thing that happens in this type of atmosphere is that the dollar will not just plummet straight down. It's going to put up a fight, and although we're seeing inflation, we will see a little bit of deflation, and it's a pretty complicated thing, right? I'm not gonna sit here and explain everything, but there will be opportunities you can have with your cash, to take advantage of things, as people who do not know how to manage their money will be desperate to get rid of certain assets, things that they view as assets. And there's going to be a sale on homes, there's going to be a sale on cars, there's going to be a sale on many things. And you and I are going to be able to take advantage of it if we're aware. So this simple portfolio is based on metals, commodities, right? Energy, the energy sector, crypto, ETFs, which are indexes spread out within a sector, that give dividends, emerging markets such as China and India, for example, and also some alternatives, some picks that I see, such as banks, such as the fertilizer sector, such as data centers, which are real estate areas that are concentrating big information hubs for computers, okay? So check it out. It's very simple. What I have drawn up for them is to put 50% of their portfolio in metals and energy. So we're talking about ETFs like SLVO for silver. Of course, I'm going to tell them to buy physical silver, and I'm going to explain why. Also, Barrick Gold, great company, and PDBC, which is an ETF for commodities. Now, why silver? Why am I so bullish on silver? It's because there's a limited supply and it's needed to be used as a conductor, mainly in microchips, which is true also for gold. Electric vehicles will need silver. Silver is going to go very high in price pretty soon. Same thing for gold. It's a manipulated market, metals, because they can't tell you, they can't let you know that this fake fiat system is losing value. And so it's manipulated so that the elephant in the room isn't shown to the masses. Energy is the second sector, which I'm encouraging them to allot 25% of their portfolio into. So there's a company called Cheniere Energy, LNG. Also, so it's based in Texas, and it's has to do with natural gas related stuff. It's pretty broad in what they're into, as well as the Energy Select Sector Spider Fund, which is an ETF, XLE, 10% in there, and a uranium ETF. Uranium, I am super bullish on, and that ticker is URA. Now, crypto, I'm gonna make it easy for them. I'm not gonna try to have them like be a crypto expert. I understand that, you know, it's difficult to wrap your mind around. So I'm gonna tell them to simply just invest in Galaxy Digital, ticker GLXY. It'll be easy. You know, I'm only telling them to put 5% of their portfolio into crypto, 3 of which I will tell them to put into Galaxy Digital, and the other remaining 2%, I will encourage them to open up a BlockFi account and put that 2% into Gemini stablecoin so it could yield 8%. The point of this is simply so that they could get their foot in the door on digital assets, a little hands-on, and see how it outperforms their cash sitting in the bank. Okay, that 8% is not even outperforming inflation. Inflation right now is 15%. Dividends and ETFs of emerging markets, VWO. This has to do with China, Taiwan, Brazil, South African companies. 5,000 companies are placed in this ETF of VWO. And then we have other emerging market sectors. VEA is a diversified international company index by Vanguard. And then VUG, where you have top companies like Apple, Visa. I have way more notes on it, but it's the big companies of the US. And so I'm telling them to allocate dividend paying ETFs or stocks, 20% of their portfolio. So 10% in VWO, which is the 5,000 companies that are overseas, and 10% in VUG, which are companies like Apple and Visa, to get a dividend paying every month, dividend pay every month. And then VEA, which is diversified international companies, I will say 15% of that. Now, a lot of people would say, why would you get into emerging markets? When you compare it to the S&P has blown emerging markets out of the water. Well, we're looking ahead. We're not concerned with what's happened in the past. In the past, the US may have outperformed other countries, but that's not what's happening in the future. There's countries such as China, such as India, that are emerging, and they will have humongous growth moving forward. Then we're looking at alternatives, right? which I'm telling them to put 10% of their portfolio allocation into. We're talking about fertilizer, NTR is the ticker. We're talking about the electric vehicle sector. There's an ETF for it. So we're not trying to pick stocks when it comes to that. A nice broad ETF is DRIV. That's the ticker. Then we're talking about techs and optics, telecommunications, Lumentum. I like a lot. And then, like I mentioned before, data centers, RQI. In all of these, I'm allotting 2% within that 10% of alternative picks. So we have 5 picks: fertilizer, electric vehicles, optics and tech, telecommunications, data centers, and finally, I know I hate to say it, but banks, JP Morgan and Bank of America. They're too large to fail, and so I'll sprinkle that in them into the portfolio. So 1% into JP Morgan, 1% into Bank of America. Very simple portfolio. Now, the plan is to every quarter take a look at it so they don't have to be constantly monitoring, and then we could rebalance the portfolio, take a little profit, put it into the sector that has underperformed, and we could move forward and live our life. I think this is a simple way of managing money. Let me know if you think I should do something better with it or if you actually like it. Peace.